All right. Well, Jim, thank you very much for joining me. And it's great to be here with, all your clients, right? All your other clients, some of our potential new clients. And we've got our colleague, Harry Melandri on, who can act as the intelligent man in the room, because I certainly don't have the on-paper qualifications of that Harry does, Bank of England, Cambridge. Was it Cambridge or Oxford? I think it's Cambridge. Various Brevin Howard, et cetera, et cetera. But classic example of the A student working for the C student, Jim. But so we wanted to chat today because we're teeing things up a little bit for this macro conference that we're having in Vail in September, end of September, which you've graciously agreed to attend. And I think, a lot of the things that we're discussing or we're going to discuss here, I think you and I are in agreement in many areas. But I think this is a really extraordinarily difficult market for people to get to grips with, right? Because it is a very different cycle. You've articulated it a lot. There is this assumption that everything just reverts to normal. It's all going to be fine. We're all going to go back to the days. And I see this behavior in talking to some clients. I've had some great conversations about, with distressed debt fund managers in Europe and the US, and how they see this client base that is desperately trying to throw this sort of Hail Mary pass of give me funding. I mean, one of my guys was telling me at 20 to 25%, they're doing 1 to 2 year funding on deals. Well, give me this funding for 1 to 2 years, because in 1 to 2 years, rates are going to be back at zero. I'll be able to refinance my commercial real estate deal, my construction project, and everything will be back at normal. And I think you and I have a structurally different view when it comes to that, but it's this right here, right now that's a little hard, right? Because right here, right now, I've definitively been in the camp. We wrote a 3-part series at the beginning of the year where we called it the economic kind of the macro trifecta. We saw an inventory overhang in manufacturing, which we just thought, everyone had over-ordered. We would go from sort of inventory famine to inventory feast to inventory hangover, and we think we're in that inventory hangover. We thought at the same time the consumer would struggle in real terms. So while everyone talks about savings levels are high still and if you adjust them for inflation, the consumer's ability to keep buying those same units is grossly reduced because we have this greedflation, however you want to term it, kind of effect. So that would weigh on the manufacturing side. We had the credit side, which even before SVB was materially tightening. And I think you and I would probably agree post-SVB has got worse. We don't have a ton of data, but we just had the Dallas survey. We can talk about that. But that was bloody horrible, frankly. And then the third one that we were looking at was kind of this construction boom that we'd had post-COVID, right? We built more homes than we built any time in the last 50 years. To accommodate this great migration. And it wasn't that we thought that we were going to have a GFC style crash. We were just going to get a slowdown in the rate of activity that would weigh on construction, and particularly in multifamily, because we think that funding is very tight and poor now, that these guys are going to struggle to keep this momentum going forward. So you had all of those 3 factors. That in turn would weigh on employment, and indeed we continue to see signs of weakening employment. The fly in the ointment has been this equity market, which hasn't responded. Now, I think actually, and I think you'd probably agree, that beneath the surface, the equity market has responded, right? And I think I'm firmly of the belief that what determines the broad equity market is nothing to do with fundamentals, period, end of story. It is purely this liquidity story. I think we could talk about where the liquidity could go from here on out, because we've obviously seen, I think the TGA story is largely played out. So then it's what comes next, with this net new issuance that's coming through, where does that money come through? But beyond, when you look at underneath the surface, that is what macro is determining, where that money is being allocated. So I think and then of course there's the bond market, and the poor old bond market keeps trying to say the recession's coming. I know the recession's coming, and bets on that. And then the equity market doesn't respond, and the data sometimes is influenced by the equity market because it influences sentiment, et cetera, et cetera. And so the poor equity bond market keeps going. It's now, I know the recession is here right now, and keeps getting punched in the face occasionally. So that's kind of my takeaway. And I do think we're at a quite interestingly balanced point. I generally think that equities are vulnerable here. We're recording this on the 27th. So Tuesday the 27th is another classic, I think, turnaround Tuesday, but we'll see with the NASDAQ up, 1 and change. So that's kind of my view on the world, and I'd love to get your input, and then Harry maybe can pull us both apart.
Okay. Let me start with your last point first. When we talk about vulnerability in the economy and vulnerability in the fundamentals, the first retort you'll get from people is the S&P's up 12%. Yes, it is, but a couple of things. The metric du jour now is if you look at the equal weight S&P, it's up 3. And if you look at the market cap up, it's up 12. So 900 points of difference. And that over 6 months is huge for that kind of number. The last time we saw anything like that was the COVID rebound, but then again, we had the VIX at 80, and that's why it was like that. And then you'd have to go back to late 99 during the tech boom.
Yep.
Another version of that is if you take the 8 big mega tech stocks out of the S&P, it's done like 1% for the year or so. So there is that vulnerability that the market is showing. We're just not seeing it in the broad index.
Correct.
And then if I was to dig down one step lower than that, historically, you cannot sustain a rally if the financial sector is in trouble. Now, you don't need the financial sector to lead a rally. It hasn't for the last 15 years. You just can't have it imploding on itself, which is what it's been doing since March. You can't be saying, oh, all is well with bank stocks down 40%. They have to kind of at least tread water, and they're not even doing that. I mean, the closest you've got to that is that while the S&P is up 12 and equal weight's up 3, JP Morgan, which is the gold star, is down 5%. I mean, normally that's a disaster, but all of a sudden that's a virtue now that it's only down 5%. So I think that the market is definitely looking at that. Now, let me back up to the beginning of your thoughts and say, I think that from a bigger picture, we can never underestimate the biggest economic event of our lifetime was we shut the global economy down and we restarted it. And we've never done that before. We never considered doing that before. There are implications of doing that.
Yep.
And
agreed.
what I mean by implications, it's not like, we're not going back to 2019. We have changed a lot of things about this economy that we probably will need another decade to understand. The most relevant, my hobby horse, and the biggest one we all are aware of is work from home. Yep. And that has become permanent, and that some not fully work from home, but hybrid work. The way I've liked to explain it to people is pre-COVID, you and I and everybody else was home 2 days a week, Saturday and Sunday. Now, most people that work in service sector jobs are home 4 days a week, Saturday and Sunday, in the office 3, at home 2. If you double the amount of time you're at home, your lifestyle's changed. And a lot of things have changed. So when we look at this confusing indicators that we're seeing out of the economy with this booming labor market, 3.7% unemployment, 300,000 jobs being created every month, even though we're seeing a rise in initial claims. Now, maybe that comes to an end with the next report, but so far we've seen that and we're scratching our head. And then we see the very poor GDP numbers. Remember last year, the first and second quarter were negative GDPs. And we were arguing whether that was a recession because it met the old technical definition because it was 2 negative quarters. Right. And so we're trying to put all of this together and make understanding of it. But I think the big point I wanted to point to is look at everything beyond the stocks that are tied with AI. It's not doing a whole lot. And then finally on the bond market, you're right. The yield curve is back to minus 100 basis points, 2-year, 10-year. It is severely inverted.
Yep.
It is inverted for two reasons. One, the front end of the curve, the 2-year note is again above 470, kind of inching towards its 5.08 peak, which was in early March. And that's because the Fed isn't looking like they're done, even though everybody was hoping they were done. We're pricing about a 75 or 80% chance that the July 26th meeting is another hike, and then there might be one more after that, maybe even more after that. And the 10-year isn't doing anything. It's been meandering sideways.
Certainly not helping to tighten financial conditions.
Right. Well, what's going on with the 10-year? If I was to say, what's that message? There's problems with the economy. Because when things go bad, what do I want to own when things go bad? I want to own the best credit, treasuries, and I want to own duration because I get capital appreciation.
Correct.
And that's why that is not following the short rates higher. It's kind of meandering sideways and the yield curve gets more and more inverted. So let's start with, this is post COVID, this is post shutdown. And so when people point out to me, well, this is the way the economy usually works. Well, you got to question anything that happened prior to 2020 because we did an extraordinary event to the economy and we still don't really understand what its implications are.
So as you look at the world right here, are you seeing signs of labor weakness or are you seeing signs of still sort of labor resilience? Because most of I'm very much of the opinion that kind of the labor market is a momentum game. So if you look at the long-term trend of unemployment, you pull it up in front of you, just unemployment, take it back into the 50s, kind of looks like where I am at the moment in Colorado. It's a mountain range. So you have very sharp peaks, unemployment's rising, it's falling, and then you kind of get these valley lows where you kind of lose momentum, you hit the bottom, the river that runs down the middle of the valley, and then you gain momentum as unemployment starts to rise gently, and then all of a sudden it goes off again. And it looks to me like we're losing momentum. We're not creating the jobs. I look at some of the survey metrics and it's interesting this month, there've been some quite sharp drops in some of the employment metrics. So I think it was Richmond that saw a big drop, Philly, Fed, service or non-manufacturing saw a very big drop in their employment component. I'm not saying we've reached that sort of epiphany moment where all of a sudden we're going to walk in and non-farm payroll is going to be minus 200,000. But I do think some of the BLS seasonal adjustments are a little generous, Jim, I'll put it like that, based on some of the other things. So where do you come out on the employment thing right here, right now?
So quick comment on your last comment about the seasonal adjustments. Most of the seasonal adjustments usually look back 3 years. What happened 3 years ago? We were in the teeth of the shutdown. They've tried to look back
Ukraine, everything, right? I mean, it's just been amazing.
Right. That's exactly right. Because normally a seasonal adjustment, they look back at the last 3 years to adjust seasonally. Well, that gets you right in the middle of the minus $20 million job loss in the 1 month, and then the millions of gains right after that. And then they said, well, let's look back 1 year to try and offset that. Okay, great. So we're going to look right back to the start of the Ukraine war. So what you wind up with is these seasonal adjustments that look screwy. And in fairness to the statisticians, they're doing the best they can. But
correct.
Boy, it's really difficult. To your larger point, what is interesting is when I look at various sorts of labor indicators, it always says, initial claims, maybe wage growth, some of the other numbers from the ISMs on the payroll indices. It looks like labor might be, looks like the job market might be slowing down. Even the number of, open jobs from the JOLT report is starting to come down. Then you get the payroll report. Boom, another blowout for the 14th month in a row.
Bond market takes it on the chin yet again, right?
Right. Because, you're right. If you looked at all of the indicators, if I said to economists around there, here's a set of indicators, what do you think the labor market is going to do? Not beat 14 months in a row and keep churning out 300,000. I do think that is a legacy, again, of the shutdowns and the reopenings. Right. People's views of labor have changed, but you're right. We have to be close to something along the lines of full employment. Well, we've already had a 3.4% unemployment rate in the last few months, and that is a 54-year low.
Correct.
In the unemployment rate.
Right.
I don't think we're in an environment where we're going to be talking about a 2 or 1% unemployment rate. There's always some structural unemployment. People are between jobs or changing careers or something. So it's going to be difficult to continue to see the labor market churn this way. Is it that companies are hoarding workers? There might be some of that.
I think so. So my model, I have a couple of models where I look at kind of the forward indications of potential unemployment. So you look at the things that typically lead the unemployment rate, and those have materially turned up. But obviously we haven't seen unemployment yet respond. And I think that's labor hoarding. And I'm a big fan of listening to the ISM conference calls, and in particular the manufacturing one and the present chair is this guy, Tim Fiore. And Tim's, I actually quite like him. He has a really good, I think, analysis of his data, that he's been doing it for a long time. And he was asked the question, what about all this labor that's been held on to? And he said, well, I'm a little worried. He goes, he thinks June is going to be an epiphany month. June, July are going to be epiphany months for the ISM. Because he said, we've been holding on to all this labor. The backlog of orders is gone, right? They've chewed through that fat. And he said, well, if the new orders come through, we're going to be okay, because manufacturing isn't sitting on its own inventories. But if those orders don't come through, and his comment was, I don't think we can keep holding on to those people. And I think that to me, right here, right now, that's probably one of the biggest things. Is there a way that we can get a burst of new order activity that gives this economy another 3 to 6 months?
Right.
I'm not sure. I don't see where, because it looks to me that manufacturers' customers' inventories are extraordinarily high. But if I'm wrong on anything, I think that was where it would be. But and we'll keep this game going.
Right. And coming back to when we talk about how this matters for the economy, what we're really saying is, how's the Fed going to respond to it? And, we could have all these indicators, and they could say that labor's rolling over, labor's got some issues, labor's got this, labor's got that. Then you print 339,000 jobs, and the Fed is over there in the big oak room screaming, hike, because we printed a bunch of jobs,
right.
Because or that the unemployment rate is at 3.7, more hikes. Well, what about all these indicators slow down? 3.7, more hikes. That's kind of the way that they start, and they kind of start and end with that metric. So it is, like I said, it's hard for somebody to say, if I was to turn the equation around and go, this has been an extraordinary labor market up till now, 14 months in a row, we've beaten the consensus. We've never done that. We churn out 300,000 jobs. We've got an extraordinary number of open jobs relative to the unemployed, like 1.7 jobs open for the unemployed. We've got, everything really cooking along. Here's the morass of labor indicators. Construct for me a model that would have predicted this. And it's really hard, given the data that we have, to say, oh yeah, this all suggests that we should have seen a booming labor market. So something's definitely changed in the labor market. And, we could maybe pivot a little bit to inflation for a second. If the inflation rate, I have been of the opinion that the inflation rate is bottoming right now because of the base effect, meaning that if you look a year ago, you had some huge monthly numbers that you're dropping off, the last of which is June, which was 1.2% a year ago. You'll probably be around 0.4 for this month. And then July of last year was 0. And then August was 0.2.
Right.
So it's easy to jump over those numbers, and you could see the unemployment rate or the inflation rate.
And I've got exactly the same. I've got some models where I model metrics, and they base basically this coming month. So I guess the June print that we get in July, and then they tick up again. Not horribly, but they do tick up, Jim.
Right. But if you take the exception, if you take the view, forget that, we're going straight to 2%. We're going to stay there. And we're going to do that with this labor market as we understand it, with the open jobs, with the number of job creation. We will see a giant burst of wage inflation at this
Right.
point. There's no slack.
No, so this is my whole point. I keep, occasionally I'll run into client base, and they're like, well, inflation's dropping away. I was like, absolutely, inflation's dropping away. Headline inflation's dropping away. So I said, okay, well, let's construct this what if scenario. Okay. So we have nominal GDP of about 7 at the moment. Now, let's exclude the fact that that's double trend, right? 2% inflation and 1.75% real growth, right? So 7 is double trend. I think that nominal GDP is basically a function of the labor market, because nominal GDP is basically pre-tax take-home pay for the US economy. And there's a couple of theories you can look at. We like to look at average weekly payroll. It gives you a great metric for nominal GDP. So we got 7% nominal GDP. So the equity bulls will go, yeah, but inflation drops. I said, okay, fine. Inflation goes to 0. And their response is, fantastic, the Fed's done. And I'm like, actually, let's think about that for a second. So inflation goes to 0, nominal GDP stays at 7. So what happens to real growth? Well, it accelerates. That's great for corporate profits. You go, yeah, but to 7? Okay, well, that's 4 times trend with 3.75% unemployment. This is not 2010 when we got 7% unemployment or 8% unemployment.
Or 2021.
Right.
2021 when we had 8 or 9% unemployment.
Exactly. Yeah. Exactly. So there is, to your point, there's no slack. So my response is, okay, so real growth accelerates. Unemployment tries to fall yet again. Wages just get stoked up again. And then all your core inflation metrics, which we haven't talked about yet, because all we're talking about is base effects driving down headline inflation. Those all reaccelerate, and the Fed is right back at square one.
Right.
They've got a more difficult political discussion to have, because they'll be trying to create all these inflation metrics that they haven't looked at before to justify even more rate hikes, because headline inflation may be low. But the reality is they can't step away.
And not only can they not step away, they probably won't step away, because another thing I've been pushing people on is, this whole idea that if the Fed pivots, that this is bullish for financial markets.
Right.
Well, let's talk about the last 3 pivots. 2020, they cut rates like mad because COVID came. They saw the economy falling apart and they panicked and they cut rates. What was the last rate cut cycle before that? 2007. They saw the economy falling apart with the great financial crisis. They cut rates to 0. They couldn't stop it. What was the last one before that? 2000, 2001. The tech bust, then leading all the way into 9/11. They cut rates to 1%, held it to 2004 because they were panicking and they couldn't stop it, the recession and all the problems. In other words, when does the Fed cut rates? When everything's falling apart.
Right.
When was the last time that the Fed cut rates because they said, mission accomplished, we did what we did, and we're going to cut rates? It was 95. It was 95. And what happened? What happened in 95? The stock market went up 37%, and it took off into 96. And what did Greenspan start talking about in 96? Irrational exuberance. Right. That we got to rein this thing in. It got out of control. Right. They already learned their lesson. So the pivot crowd, I will say to you, when will the Fed pivot? When there's unmistakable signs that everything is falling apart. Right. They're trying to stop it from falling apart. They'll cut rates. It won't work. Do I want to buy stocks when that's happening? That's like the single worst time to own stocks.
I know. It's amazing. I was looking at the rate of change in the S&P, and typically it bases in the recession. In the recession, right? We're up, 18, 20% year over year. We've never, ever seen that price action in the recession, right? So and I think we still need to go into the recession. I think, last year's, I know technically you could argue it was a recession, but clearly the NBR didn't agree and the market didn't see that as the case. So I think, to my mind, this is just sorry, I've got someone calling me. This is just an unsustainable situation, and that either the Fed isn't done or the data is going to turn and the market's going to turn, and the market will turn on something I think the market will have to turn on this liquidity metric, which maybe raises. Do you have any views on this liquidity story? Because obviously it's now a pretty pervasive story. We've all seen the TGA rebuilt. I do wonder occasionally, if I put my little tinfoil Machiavellian hat on, Jim, and I think, what is Treasury trying to achieve as opposed to what the Fed is trying to achieve? And obviously, theoretically, the Fed is independent and Treasury works for the White House, and the White House wants to get re-elected next year. So they don't really want to see the equity market get crunched, and they really want to keep spending money, and they really want the economy to keep going. So when I kind of look at well done, you've managed to refinance the whole TGA via the bill market. Well done. But I look at further out down into the rest of the year, and it strikes me, and not just me, some people I think a lot more qualified when they look at the plumbing of the system, to say maybe rolling over more than $1 trillion worth of bills every single month may not be the best way to do it. And we've got an additional net financing requirement this year and next year. So it looks like to me we're going to have to release some duration into this market, and that will drain bank reserves. So what are you thinking?
Yeah, so a couple of things. Let's talk about just some simple high-level plumbing. When money is when you buy a Treasury bill, or I buy a Treasury bill, and we give our money to the Treasury and they give us a bill, that money goes into the general account, the TGA. And that money, for these purposes, is money outside of the financial system.
Right.
There's another pot of money that's outside of the financial system. Money market funds that have as their counterparty the New York Fed can place money at the New York Fed in their reverse repo facility, get 5.05% interest on a one-day loan. And that's also money that's outside of the financial system. So when we were in the middle of this debt fight and we were watching the TGA number head to zero, what is happening is that's a pot of money that was out of the financial system.
It's coming back in.
Coming back in. We were adding liquidity.
Correct.
So now we're going to be pulling that liquidity out of the financial system because the fear is we're going to pull it out because all these people are going to be buying Treasury bills, and that's going to be money coming back out. Now, that money eventually comes back, right? Because the government gets that money. What do they do with it? They pay workers' salaries, they pay benefits, they pay the light bills of government buildings. So that money eventually comes back into the financial system, but it's sucked out real fast, and then it's slowly back in. Except we have a different nuance this cycle. We had $2 trillion or have $2 trillion in this reverse repo account. That's already out of the financial system. Yeah. So the reverse repo account goes down as bill issuance goes up. And in other words, people are saying, money market funds are saying, we'll buy these bills. We won't use that money to reinvest in reverse repo. That's just shifting from one account outside the financial system to
another one. Essentially, so the internals of the financial system, and I agree with you completely, are essentially the liquidity is being maintained. Right.
It doesn't. It's
all happening essentially off balance sheet or outside the financial system's balance sheet.
But you brought up a really good point. So what people are getting excited about is for the last 3 weeks, there's been this burst of bill issuance. There's been this drop in the reverse repo account. And they're saying, see, we're just using money already outside the financial system to just redirect it to bill issuance. And it doesn't affect liquidity. Hallelujah, we fixed the problem. Except we're issuing 42-day bills. We got to do it again in 42 days. And then we got to do it again 42 days after that. And
we're not small amounts, Jim. It's not small amounts.
Right. And we got to hope that at some point that these money market funds don't migrate back to, RRP. And then the only way the Treasury gets its money, remember the old adage in the bond market, there are no bad bonds, only bad prices. The Treasury will get financed. It will suck money out of the financial system. So we've kind of gotten past it for 42 days because 2-month Treasury bills are kind of the fulcrum. And we'll wait and see if we do it again in 2 months, and we do it again 2 months after that. So far, the liquidity issue is okay. Now, I want to say so far, because I want to make two other really quick points. Anybody that can tell you what the RRP is going to do next is lying, because no one knows what that's going to do next. I don't know. I just watch it and react to it.
Yeah.
And because I've heard people, look, I've heard Zoltan Poznar. He knows more about this stuff than you and I and everybody else combined, and he can't get it right. In other words, this is not a knock on Zoltan. Us mere mortals can't figure this stuff out. If he can. So we'll see. In other words, why I brought that up is so far, it seems like RRP is going down, bill issuance going up, so it's not being a drain on liquidity.
Correct.
But we have a settlement. We have a settlement today. We have a settlement of bills today. We have a settlement of bills Thursday. We have a settlement of 3-year notes on Friday. We've got another big round of settlements next week. We'll see if this continues. At any moment, all of a sudden we could look and go, RP stopped going down, but they still got another couple of $100 billion to issue this week. That means it's coming out of bank reserves.
Right.
And
I do think, don't you think there's an element to which, I mean, I was listening to the Treasury Market Committee is suggesting that they don't really want more than 20% of the total Treasury issuance in bills. That's kind of like, really? Do we just be rolling this thing over on the perpetual never, never?
Yeah, the perpetual reinvestment risk, because bills mature and you don't know what you're going to get. The Treasury always makes this problem. If I could just riff on this, if you go back and you look in history, when we were at 20% interest rates in the early 90s, the Treasury, people were complaining, oh, well, you can't be issuing 20% T-bills. That's outrageously high. The yield curve's inverted, so issue 14% 30-year notes. Why are you locking in 14% for 30 years? Is beyond me. And then when we got to zero, I was screaming in the opposite direction. I used to joke pre-COVID that if I was on the Treasury Boring Auction Committee, the new yield curve would be 30, 50, 100 in perpetual. Because I'd lock in. You want to give me 2% for 100 years? I would issue everything for 100 years.
Even Argentina got that joke, right?
Right, I know. But you know what? But Steve Mnuchin didn't.
No. So I look out a little bit further, and as I said, I mean, there's this net issuance to come, which is not inconsiderable this year, and even bigger next year. And you have to assume that some of that we can't be rolling over $2 trillion in bills. Right? We're going to have to, some of this is going to have to come in form of extended duration, right? And I think that plays on the bank reserve. So as I said, I look at this equity market and it looks extended relative to liquidity. And I truly believe it's mechanics, right? You can look at the most extended, for example, FANGs have ever got to the underlying liquidity. And we just got back to the same level that we did in March 2021, and then they dropped like 16%. And I think that's the risk now, even if liquidity stays where it is. And my gut is telling me it's going down. And I saw, and you're absolutely right. No one knows, right? This is kind of you might as well just react to the data.
Right.
But we all know Mike Wilson has been extraordinarily negative on the equity market, and he's an exceptionally good equity analyst. I'm not trying to detract from him at all. But I just saw Morgan Stanley's forecast for where they think all these liquidity metrics are going to go by the end of Q3. And if they are right, big if, then we'll be bloody lucky if the equity market isn't down 17% from here. And the base case is it's probably down 25 to 30 if these mechanical relationships hold.
It definitely, you could definitely see that, especially if you go back to our earlier argument, if you're talking about on a market cap weighted basis. When you look at a company like NVIDIA that is up 200% and is trading at 40 times revenue. By the way, MI2, multiply your revenue by 40, and how fast would you sell it if somebody offered you that price for it?
Pretty damn quickly, Jim.
Yeah, it's the same with me too. When the correction comes in something like that, this is just general market dynamics. What's going to happen when NVIDIA corrects? It ain't going to correct 5 or 10%. It's going to correct 40 or 50 or 60. That's what those companies do when they eventually correct.
Yeah, exactly. We have this thing that we call a classic bubble pattern, and we've gone back and looked at everything through history all the way back to sort of 1929 and Saudi in 2006, for example. We had some single stocks like Triple D, that 3D printing company that was around a few years ago that everyone loved. And there is you get this parabolic move, and it's a bit like the F-16, right? The F-16 goes vertical. If you've ever been to an air show, you see this thing and you're like, oh my God, this thing is going to the moon. But the problem is it's a standard jet, right? So it needs oxygen to keep burning. And it's a bit like a parabolic up move needs. A parabolic up move needs liquidity to keep going. And if at some point that liquidity just gets a little thin, the move the F-16 doesn't hit 39,000 feet, which I think is its operating ceiling. And it doesn't fly off sideways at 39,000 feet. It goes up and then it sputters and then it drops. And it drops hard. And then you hope the engine recatches and it goes off again. But frequently, if the liquidity dynamics have changed, we can never go back to those previous highs. And when you look at the setup in the NASDAQ, for me, it looks frighteningly like the dot-com bubble, because the dot-com bubble, ultimately that parabolic up move was fueled by the Y2K money, if you remember. We can't add a zero to a computer. The whole financial system is going to break down. Here's a few $100 billion. And I remember one of my hedge fund clients laughing when I put the graph up there, and he said, I was sitting in the office and it was one of the big three, you would know the name. And he said, we literally got the principal coming over the hoot, and we were sitting in the London office, and the guy said, they've given us the money, start buying shit. And the NASDAQ went parabolic. And you look at it this time, and it was the Y2K money. And all right, unlike the dot-com bubble, the money just hasn't fully been paid back, but the liquidity is being drained out of the system, and it should be being drained out as we get further through this year.
Quick point on that, on your last point, and then about the NASDAQ bubble, about liquidity being drained out. One of the reasons why I think the TBAC, the Treasury Borrowing Auction Committee, and others are pushing on this whole idea that you want to limit to 20% of bills is that $1.9 trillion in the reverse repo that they want to drain down and get, to do the liquidity. That's held by money market funds. Money market funds cannot buy anything longer than a year. Right. And their average maturity is around 20 days.
Right. Yeah.
So if they start issuing duration, then that entire RRP is off the table. You can't trade the RRP for a 3-year note.
Correct.
You can trade it for a 2-year bill. And so if they start issuing duration, then we will have a liquidity drain problem. So they're just, that's why they're playing this giant bill issuance thing, is because they're trying to play off of that.
Yeah, and I wonder, and it brings me back to that point I made earlier, I wonder, are we going to end up at cross purposes between Treasury and the Fed? Because I think the Fed needs that equity market to come down, to take some animal spirits, to slow the labor market. And if Treasury, that's trying to get Joe Biden reelected, doesn't want to hurt the equity market, wants to keep this economy growing, are we going to end up in a situation where the Fed is either going to have to go significantly higher, and I do think do significantly more damage to certain sectors of the economy?
Yes, and that's going to come Labor Day. Let me go back to the base.
Go ahead, go ahead.
Because that's going to come Labor Day, because while inflation is falling, it's hard for Jade to remember his speech for 8 minutes in Jackson Hole a year ago, that there's going to be pain and it's going to be awful. He can't make that speech now with inflation going straight down. But if it bottoms in June because of the base effect and starts back up, he might have to, when he gets to late August next year, give the same speech again.
Right.
And
I think it's going to be, did you remember that speech? Because I mean, you raise speeches, and I think it's interesting. So we have the big Sintra speech. So Sintra is the Jackson Hole for the ECB, right? Lovely Portuguese town. And
it is fantastic. If you've
got the big four, right? So you've got Lagarde, Bailey, Powell, and Ueda. And if you remember it was
Karsten,
this time.
don't forget Augustine Karsten, the big
Yes.
five.
Well, I think, I don't want to be too rude, but he could be the big six. But actually, it was this time last year where they all held hands and they gave that really forceful view that inflation is not done.
Right.
And they have to really tackle inflation. And they have to tackle inflation. They've got to get. And I thought Lagarde's speech was very interesting. Or that, today there was that research paper that came out on the IMF talking about essentially greedflation in the European economy, and if European companies decide to pass on wage increases, then stuff is going up even further. Then rates are going up even further. But I think we've got that same dynamic here in the US. That unless we start to see some of these costs absorbed, or at least in the US case, maybe now some of these reductions in input prices passed on, these central banks are going to have to hike more. So I think tomorrow is going to be it's quite an interesting speech.
And don't forget, you've got the complement of last year. Last year, we had US inflation at 9% in June of last year. We were the high man on the totem pole, and everybody was looking to Jay about the inflation problem. Now it's Europe that's got the inflation problem. We've got less of the inflation problem. So I think that we're probably going to look more to Andrew Bailey and to Lagarde and go, what are you going to do about the inflation problem now? Because you're the ones that are in the hot seat, where Jay was in the hot seat last year, but still same story as last year. It's just the orientation has shifted a little bit.
Right.
And they've already made some noise. They can't back off of this right now.
I don't think so. I don't think so. So we've got my colleague Harry Melandri on, and Harry, you've been listening to us, and any thoughts on the things that we've said? Any questions that come to your mind?
So I thought every time I came up with a question, you guys then went over it. So that makes it a bit trickier. But the one thing that I didn't think you discussed, or, not maybe in the depth I'm looking at it, was the US fiscal position. You've got an 8% of GDP deficit. And you've got rates 5%, in the 5% area and potentially going higher. How does this get normalized?
Oh, that's a tough question, how it gets normalized. You're right that, the fiscal position, the big deficit, debt service is exploding higher. It's now at the highest levels in about 20 years. And right now we've recently crossed debt service now is more than the defense budget in the United States, and it's going to continue to go higher. I'd have to answer the question is it's going to have to be market discipline. If you're waiting for some Jeffersonian statesman to show up and say, for the good of the country, we have to stop spending and we have to cut back and do this, they're never going to do it.
Right.
The only way that they're going to do it is the market puts its foot on their throat and tells them to stop. And that is not 3.8% 10-year notes. So ultimately, if you ask me, when does this come down? When the bond market decides that it's had enough. And for the moment, the bond market has not had enough. I don't know, Julian, what's your thought on it?
No, look, I think you can see my cynicism or my agreement when you talked about the inability of politicians to sort of get to grips with this. I just don't see. I think, really starting with Trump, but certainly post-COVID, fiscal rectitude was taken out to behind the bike sheds in the US and shot through the forehead, right? I don't see any fiscal rectitude there. And I also think that fiscal demands are inordinate, Jim. Aside from the debt issues, we're fighting arguably 3 wars, right? We're fighting a Cold War with China, which is inordinately expensive, a kinetic war with Russia, and a climate change war. All of them demand vast quantities of fiscal spending, none of which is productive, particularly. So I really struggle with this, and I think some of my clients have really been struggling with this too, right? I'm sure you've got as well big real money managers who would love nothing more to be able to pile into 10 and 30-year treasuries, just because they can see the economies should be starting to weaken, and they'd like to take that duration exposure. but kind of struggle in an environment where the term risk premium is basically negative still.
Right.
And I think this is hugely problematic. I keep going back to the 1960s. You have this view that we're not going to put Humpty Dumpty back together again, right? That the world has changed, that the inflation picture has changed. And I'm firmly of that view, at least in a long enough transitory period that it really will count to your portfolio. So don't get me wrong, we've been in deflation or disinflation for 400 years since we started to enclose common land in the UK in the 1600s. But we've had these periods of transitory, uncomfortable periods of long and sticky inflation. And I think we're there, and this fiscal spend worries me because it looks very much like the setup that we had in the late 1960s, where you get the initial burst of spending coming through, you pop inflation out of its nice controlled range, Jim, it jumps up, it becomes uncomfortable, the Fed gets tough, they try and address the problem. We then had a banking crisis in 66, 67. They actually made the error, and I think they're cognizant of it, of not easing into that. Now, whether they're going to be able to hold that line, we have yet to see. But when they shifted, what happened is they started to lose the long end of the bond market. So I would agree with you that I think they're physically trapped. I think they'll either have to remain, and it's going to be difficult for you. The point that you made, this headline inflation rate, at least for the moment, will come down. I hope you're right. I think you're right. My models are saying the same thing, that the headline rate will pick up a bit. So Powell will be able to double down and go again. But if they don't show that resolve, I don't see why the bond market would take the risks of, and you won't get a bear steepener, right, as term risk premium starts to rise. Because we're giving the Fed inordinate credibility, Jim. I don't think you disagree, right? I mean, a term risk premium, given what we went through in inflation, a term risk premium of the one that we have at the moment is 110%. Fed has all the credibility in the world. 5-year break evens, anchored around 2%. All the credibility that the Fed has in the world. But if they blink for whatever reason, then I think they can lose control of that really quickly. And my base case is they won't blink, but but if they don't blink, that means they're going to have to do more tightening. They're going to have to do more damage to this economy. They're going to have to drive us into a recession. The setup, as I said, in equity markets is extraordinarily unusual in that situation, to be up 20% on the cusp of a recession.
Right. If they blink, and that means they back off in the rate hikes, they mumble something about 3% being acceptable and of inflation, and the new target is 3%. I get it that's what the stock market wants to hear. But
I don't know whether they'll like it when they hear it.
Right. I was going to use some salty language. The bond market is going to say, if you don't give a shit about inflation, and I don't give a shit about your bond market, then at that point.
There you go, right?
Yeah, exactly. So if the Fed blinks, how do you know the Fed blinks? Watch yields on the back end of the yield curve go straight up is what would happen. The reason that they're being held down now is because they don't think they're going to blink, and they think they're going to adhere to the old adage, the Fed keeps hiking till something breaks. And that wasn't SVB. There's more breakage to come. There's more breakage to come. Yeah. Harry, do you have any other questions for us?
I don't know how long we've got, but if we have the time, I was really struck by the point you made about rents, and that there's a natural momentum on rent inflation. Just as all the base effects are dropping out of the CPI numbers. And the combination of things, it looks awfully like the late 60s, early 70s to me as well. I remember there was a UK Prime Minister called Harold Wilson, who talked about the white hot heat of innovation when he was explaining why he could run huge deficits and it was going to be okay because we'd have productivity growth. And I've just seen the White House announce a whole series of bills designed to to promote industrial policy. I last heard about industrial policy when I was at college. It had just gone out of fashion in the 1980s. All of this is looking, if it's not causatively inflationary, it's got all of the same hallmarks as the inflation, as the last time we had a big inflationary surge with big deficits, base effects, commodity prices squeezing, and governments deciding to allocate.
Yes, let me spend money to lower inflation.
Right. MMT.
Yeah, exactly.
Yeah. Yes. It is worth reiterating that earlier point you made, Harry, that people are looking at the rental numbers from Zillow, from apartment.com, and they're saying, look, the year-over-year rental numbers are falling apart. But that measures changes in rentals. That measures the last marginal rent was lower than the previous one, and they are. But what is the vast, vast majority of rental rates? Zero. Because you rented a year ago and you're still renting, and you set the price a year ago and it still applies now, is what it turns out to be. And very few people that are renewing their lease will see a drop in their rent. They might see the same price or small increase, but they won't get a drop. If you're paying $2,000 a month in your rent, and your landlord's not going to come to you and go, well, renewal's up, how about $1,800? No, he'll say, just keep going with the 2,000.
Yeah.
So
exactly.
what I'm arguing here is, when we look at those apartment.com and those rental numbers being down so much, and everybody keeps screaming that rental inflation is going to collapse, those numbers are way understating how much rent's going to come down. Now, the OER numbers are overstating it. Those numbers will come down, but they won't come down nearly as much as everybody thinks. And so that rental inflation is not going to be the thing that's going to offset everything else. It will only come down a little. It won't come down a lot.
Yeah, and I agree, Jim. I'm looking at one of my models here, which goes out a year, and it shows OER dropping year over year, dropping to like just under 6%.
Right. And
but so that's still highly elevated, right? I mean,
right.
And you go back to your base effect on energy. I mean, as I said, I look at the services inflation that Powell's highlighted, right? So he looks at the X shelter one, and I like to look at the services X energy one. And so when you look at the X energy one, it hasn't shifted at all. The X shelter one has, because energy's in there and it's fallen. So what happens in a couple of months if that thing's higher? Then I think we've got a few fun and games.
Right.
I think we've really got some fun and games.
And it's important to understand about inflation. We hit 9% a year ago. We're going to probably be 3% when we get the June number, and then we're going to start drifting higher. At least that's my call. But I'm not saying we're going back to 9. No. If we go back to 4, 4.5, 5, Jay Powell has already said that neutral on interest rates is 50 basis points above the inflation rate for the entire yield curve.
Yeah.
So if we go to 4, 4.5, he is saying then that to get to neutral, every single interest rate has to start with a 5, every single one. Well, we're at 3.7 on the 10-year note.
And if that stays at 3.7, you've got to compensate, Jim, right? So what does front rate yields have to be? 7?
Right. Well, they'll probably be closer to 6, right, is what they would probably be. But so what's the difference if we go to 3.5, 4, 4.5? I think we're going to go more 4, 4.5. Is we've got more pain in the bond market coming. We've got more rate hikes coming, even with that level of inflation. But some people have been so deadened by it, they think that 4% inflation is some kind of victory. It's not. It's not a victory at all.
Right. And I think one of the things that Harry and I have been, well informed because of our old policy contacts from our Medley days is this concept of opportunistic disinflation that they've pursued. This idea that, there were kind of two approaches you could take when inflation got this high. You could do the VOLCA, deliberate disinflation, right? You take the economy out into the back garden and you just sort of blow its head off, right? And you kill it and inflation goes away. Whoa! Right?
Yes. That is a way to get rid of inflation if you want to.
Right? Or you can do the sort of deliberate disinflation, and you smack the economy down onto the ground, and you don't kill it, but it's lying on the ground and it's riding. And every time it tries to raise its head, you smack it again, right? But you keep it on the ground for a long time, and you hope over time that something comes along, and we get a burst of productivity, and everything's great, and it's all good. But I think people woefully underestimate how long that process takes if you adopt that approach. It took basically 4.5 years for Greenspan to do that in the mid-90s. And he had one of the biggest post-war bursts in productivity that we've seen.
Right.
And basically rates were unchanged for 4.5 years. So to your point, if everything has to have a 5 handle on it, and for how long? 4 years? 3 years? I mean, it's sure as hell not what's priced into the bond market.
Right. That's a really good point. It isn't that, we got everything to a 5 handle today. Okay, now we're done. And we have to stay there for an extended period of time,
right,
in order for it to start to kick in.
Right.
So that is the problem if we continue to see sticky inflation. And then you turn to a stock market that, even with the AI stocks going crazy, is trading at a forward PE of 20. And you're starting to talk about how does that, because typically you're supposed to compare PE ratios with interest rates. That's your metric. And if interest rates are starting to move higher towards a 5 handle, you don't want to be paying 20 PEs for risk markets in that kind of environment. You're overpaying for them. 20 is a fine PE to pay for if rates are 0 and you're in the middle of a recovery. But we're not at 0. And it's not clear we're in the middle of a recovery right now.
Right. Well, look, I think time's up, and I wanted to thank you. I think this is just illustrative of we're going to have some really good people at the conference, and I think there's a lot of, because we're going into 2024, right? So this is in September. We're going into 2024. All these fiscal things are going to get really, really, really interesting as we position for an election year in the US. And I think how what Treasury's doing, what the Republicans are potentially suggesting, I think will get really, really interesting. So I think I'm hoping the conference is going to hit at the right time. We've also got, we haven't touched upon because it's not really our thing, but we've got this whole geopolitical issue between China and the US and where that's going. I don't think that's getting better, but I think both of us would agree that has really huge structural inflationary impact and competitive productivity impact. So I think that's important. We're going to start talking. We're going to talk about something that's actually pretty close to my heart, because I think you and I have gone to a lot of these conferences, and we all have great intellectual conversations, and then you're kind of like, how do I make money out of it? And so a big part of what we do at MI2 is recommend trades, and we're going to take it one step further and recommend portfolio allocation suggestions to people, and get people who I think are really good at doing that, Jim. So we can't just pontificate about stuff. We actually have to put, some trades out there. And I think it should be really interesting. And are you bringing your wife? Here's the question: or is it just you?
It's unclear at this point whether my wife is going to come. And
the only reason why I bring it up is you have to know that it is the most beautiful time of the year to be up there.
Absolutely. I've been there that time of year. Absolutely.
So anyone who's sort of on the fence about, can I cash in the brownie points to go and spend 3 days in Vail, my partner will just kill me, should know that you should bring your partner. We're going to have a ton of stuff on offer for them, and they will actually love you. So you'll win brownie points. How much better is that?
Absolutely.
You could ask for. So look, if you're interested, guys, please go ahead. I'm sure the guys at Arbor can help you, direct you. But otherwise, if you go to the MI2 website, there's a link on the top. I think there's still even an early bird special. We'd love to see you. And I'm really excited for the time we get to spend in Vail, Jim.
Yes, I'm looking forward to September in Vail. It is a fantastic time of year to be there.
Thanks, everyone. Cheers.
Thank you.
Bye-bye.